Well, I think that the move really began about a week ago on September 1st. You know, the euro was going above 120. Sterling was testing 135. And it looked like the dollar was going to take another leg lower. These currencies were moving higher. And then the chief economist of the European Central Bank spoke. And he didn't really say anything about the direction of the market. He just noted that the euro's exchange rate against the dollar is an input into the ECB's economic forecast and their assessment of the economy. So this really helped spur a bout of profit-taking that I suspect would have happened anyways. But this bout of profit-taking came through all the capital markets, and including the stock market. And I think that this is just a correction. I think the major underlying forces that are driving interest rates, equities, currencies, is that the interest rate differential the U.S. used to offer over Europe and Japan has narrowed. And the growth differentials look like they've narrowed as well. It's hard to know because we were all hit with this pandemic and the economic shutdowns. But it looks like the Eurozone economy, excuse me. It looks like the Eurozone economy is recovering smartly, and many people expect the European Central Bank to recognize this at this week's meeting. The Bundesbank, German central bank, has already, I should say the Bundesbank, it was the German government that had already revised their forecasts higher for this year, meaning that the recovery is stronger, but that takes away the recovery from next year. So they revised up this year's GDP forecast, but revised down next year's forecasts. I think there's also a lot of supply, and that's as the Treasury Department issues more debt. Remember, in the beginning of the crisis, it issued a lot of T-bills, and now what it's going to do is roll it into the long end of the curve. And this added supply, along with investment-grade corporate bonds, lots of supply coming. I think that's weighed on things, but I think you're right too that you look at how's the U.S. economy doing, and I'd say the two strong sectors, one is autos, and the other is the housing market. And the part that goes into GDP are things like housing starts, and of course permits, so you can build your house, is a lead indicator. And so housing starts have been very strong. We're going to get that report again next week. But that's been a strong sector, but also new home sales and existing home sales, helped by low interest rates. And so I think you asked, well, has this back up in interest rates? Is this going to curb the activity? And I'm not so sure it will in the short run, because I think it's a while for these to filter through. And already we've seen the Treasury yields pull back. They were above 70 basis points, and they've pulled back almost 10 basis points. And when everything is said and done, mortgage interest rates are still historically very low. I'm not really seeing, I see a lot more refinancing activity, people who are with older mortgages trying to get lower interest rates. Same thing a lot of companies are trying to do. But consumer credit in the U.S. has only just begun growing. It got hit very hard in the COVID, when the COVID epidemic was at its peak. We lost about $1 billion in consumer credit. That is, consumer credit was reduced by about $100 billion, and it's only begun growing now for the last 2 months. So I think that American household balance sheets are perhaps in better shape than they were before the crisis, but economic insecurity and employment insecurity is still very high, and so I think that will still curb a lot of the consumption going forward. There's some functions at banks which ought not to be done at home, if possible. And those would involve things like trading activity itself. There are all these protections. I mean, you think about how much banks spend money on to strengthen, make their systems, their telecommunication systems robust from cyber attacks, from being able to have duplication straight through processing, and the sort of the checks and balances on traders, and it's very and this activity that some people find difficult to distinguish from a casino. And so I think those kind of activities might need to be in a more centralized location. But I think that a lot of jobs, I think I was reading about a third of American jobs might be able to be do on a permanent basis. On the other hand, you do mention some very important things, I think, about work and what happens. And I think if one is ambitious, that FaceTime you speak of, those relationships one builds by working alongside somebody. And I don't think that we've evolved yet sufficiently with this WebExes and internet to overcome this, to really be able to build solid relationships that are trusting, that you need for work colleagues, and also to help younger colleagues learn jobs and become familiar with not just the work action but the culture. I think that's what oftentimes guys with gray hair like myself forget about things like that. It's not just the work and the output, but it's about the social characteristic of work that's so important. I heard that Bloomberg is paying employees like $75 a day for that daily commute. Whether it's, apparently, to your point, people are still reluctant to take, say, mass transportation. Whether it's a bus or a subway, people are more reluctant to. And so I think employers, in some countries like Mexico, it's common for the employers to be able to bring their employees to the office. So I think that these kind of things, I think, are interesting ways in which the social contract between employer and employees are going to be has to be rejigged, have to be thought through. I know my employer gives I don't know, $25 or $30 a month towards public transportation. I don't know a lot of businesses that do that.